Hi, my name is Mike Bonte-Friedheim. I am the Group CEO and founder of NextEnergy Group. We started NextEnergy in 2006 to build a specialist investor focused exclusively on the solar sector, and I've been doing that now over 16 years. Our track record is quite impressive. We've invested in nearly 400 utility-scale solar assets across geographies, across countries, and across the asset life cycle. Solar has a key role to play in the energy transition for a number of reasons. One of the most important ones is that new build generation in the solar sector is the lowest cost power source today. And so as we face a world with increased energy and power prices, solar has a key role to bring those power prices down. Secondly, solar power can be, or solar assets can be built in very short timetables, which means that that impact happens very rapidly. On top of that, we contribute through new build solar generation assets to an increased energy independence in the markets that we are active in, where we reduce the import of commodities, of carbon-based commodities into those countries, again, increasing energy independence. And then finally, solar contributes significantly to the decarbonization of the energy generation of the power sector in the countries where we are active. So a very important role, especially as we look at an ever-increasing demand for electricity in the main markets across the globe. For the last 24 months, we have had a kind of seesaw development in the cost of building new solar power plants. On the one hand, we've seen increases in the supply chain, i.e. the cost of technology coming primarily from the Far East. We've seen increases inflation-based on the workforce, on the additional components that go into building a solar power plant. More recently, we've seen actually the prices for primarily modules come down significantly as the supply chain constraints have been mitigated. In addition to that, or in parallel to all of that, we are seeing an increase in the power prices, as I said earlier, across markets. And so we have drivers that lead to higher investment, CapEx investment costs for solar assets. But on the other hand, we have higher revenues because of higher power prices when we start selling power into the markets. So the ultimate balance, from our perspective, if done in the right way by a specialist investor like ourselves, results into a net positive effect for investors as they come into the sector at the right moment in time. The main headwinds we see on the solar side of the power generation of the renewable sector is really driven by the lack of projects that can be built rapidly with grid access in short order. So grid constraints, permitting constraints are the main headwinds we face in the sector. As we look across the market today, there are few projects that are indeed ready to build that cannot secure funding, debt or equity financing to get built. So that leads to a situation where we need more projects to be at the ready-to-build status in short order to accommodate that growth that we were talking about earlier in the solar sector, and of course allow investors to participate in the growth of the sector in that incremental investment requirement that is needed across geographies to meet government's objectives, be they net zero, be they growth in solar capacity in their respective markets. That's the main headwind we face. There are, of course, other drivers such as increased cost of debt financing driven by higher interest rates. But again, we have offsetting effects of other drivers in the sector that allow us to mitigate some of those other headwinds. So really the largest headwind in the sector right now is indeed the lack of ready-to-build projects across geographies. A specialist market participant in any sector, but as we're talking about solar today, let's focus on the solar sector, can generate more value for investors or achieve better investor outcomes through a singular focus on that one technology. It is impossible, if we try to be good at everything, to be great at anything. And so a specialist can, one, build a culture around outperformance, around focus on a sector. It can structure its teams, its systems, its presence to focus and be successful in one sector rather than building up multiple sector-specific knowledge, multiple structures to deal with a variety of issues. On top of that, as a specialist with a long-standing experience, investors can benefit from all of the work that that specialist has done over the last many years in that specific sector. That's very different than what generalist asset managers, generalist investors across energy transition or renewables more broadly can deliver for their investors. We have seen an increase in capital being allocated to the solar sector. And so naturally, where the supply of projects is static or not increasing as fast as capital deployed, returns have a tendency to come down. But that's a very general statement. You then have to delve into the specificities of the sector, of the geographies, of the life cycle, and when you invest in which part of the life cycle. So we at NextEnergy are able to look at different geographies in parallel for our investors. And so we can find the most attractive geographies from a risk-return trade-off and invest in solar infrastructure in that market. So we're not forced to invest in a certain market in a specific geography if returns are less attractive. For example, if returns in North America become less attractive, let's say for the IRA, we can then shift our focus more to Europe or to other OECD countries to deploy that capital and achieve better performance on a risk-adjusted basis. The other point to note is that we can look at market segments where there is less demand, less competition for assets, and therefore we can secure better returns. So we at NextEnergy Capital specialize in that market segment, which is comprising small and medium-sized individual assets. And in that market segment, we are only seeing very moderate increase in competition, where for larger assets, larger portfolios, operating portfolios, we see much higher demand and therefore more competition, lower returns in that segment of the market. So it's about defining where you can achieve outperformance, having the ability to pursue that market segment geographically or in the life cycle or the size of the individual assets. And that's what we spend a lot of time looking at to understand where the unusual opportunities exist that allow us to achieve and continue achieving outperformance.